Hey guys, welcome back to another episode of Shifting Gears. My name's Grayson Harris. It's Henry Byers right over there. Summer's winding down, Henry. We've had a pretty interesting summer full of some pretty interesting headlines, a few interesting things that are indicative of what we can look forward to for the rest of the year. So today we'll kind of just be talking about the overall state of the truckload market. We'll go into a little bit of the empty containers and all that stuff that's piling up on the West Coast, as well as some other things that we're seeing on the ocean side that are, of interest to everybody else. So without further ado, Henry, why don't you get us started, man? What you got for us?
Yeah, so really been interesting. Leading up to July 4th, we really saw the market do a bit of a head fake.
Yeah.
It looks like things could get a lot more volatile in the second half, especially when you considered, the rise in imports from overseas. But Labor Day, this is one of the strongest trends, and you can see very clearly over the past 5 years, this is one of the strongest trends in the truckload market as this lead into Labor Day. And boy, did it disappoint to the downside. So, where we had a head fake, July 4th, we'll go into, how that plays out in both spot and contract, and why this is potentially, happened to the spot market. But neither here nor there, it certainly speaks to, where we're at economically, and heading into the election. There's a lot of uncertainty, and I think a lot of, economic data points that I would say are a little bit more lagging indicators that we tend to, we have this real-time data that we really can see the shifts very clearly in the market. But it's kind of like the economy is really nowhere to go. It's bad out there. And as of the last revision in the jobs report, I think it was over 800,000 fewer jobs were added last month than the month in the prior year, same month of the prior year. That's pretty significant. And then the revision was like for more than it even was initially published for. So the economy's finally kind of as the freight market's wanting to turn, the economy's like, I don't know, not so yet. We may need some interest rates to come down. Yeah. So that really is, putting a lot of, soft pressure in downward pressure in the spot market, which you can see pretty clearly here. This is spot rates. This includes fuel, and then fuel's going down. So you have
going down for a while.
Well, so you have the surging demand it's, an ocean container freight's not, directly related, but it's to what happens in the diesel market per se. But, certainly when demand rises, you would expect to see some upwards pressure on diesel prices. But diesel's really the thing here that in conjunction with just the kind of that failure leading into Labor Day, spot rates, not seeing any upward movement, it just, kind of further pulled it down. What I was talking about with spot rates, contract rates, in the lead into July 4th, that gap between the two was narrowing. So this is really interesting because if you look at pricing and bid cycles, this is a really popular time of the year to, negotiate truckloads. Typically, this second half is a lot busier for a lot of these big shippers. Just looking at peak holiday retail season, it makes sense to do it kind of during those summer doldrums, especially in before July 4th, where you typically see a decent spike. But as you can see, July 4th, we had that gap was narrowing significantly. But what happened is I think shippers are now feeling that they've chased the bottom of the market for, well over a year. And so really they're thinking, okay, so my volatility, my risk, we've certainly been saying it, is to the upside. And they've been, hearing that. And they've been living through the COVID cycles as well. So they understand what volatility is now. Yeah. And you could say that, with a short volatile spike like we saw prior to July 4th, it really caused some of those contracts being signed within that next month, 2 months for, their guidance to be, hey, maybe we need to be a little bit, accepting, a little bit more accepting of higher rate levels. And so contract rates have actually been ticking up slightly here. Yeah. You can't really see it. It's not noticeable yet in terms of a long-term 5-year trend. But spot rates have been going down while contract rates have been easing back up. Now, will we see contract rates, start to ease back down? Typically that's what you would see is it's kind of a lagging indicator, but they tend to move together. But you can see in periods where it's really volatile and then it becomes not so volatile, it takes a little bit longer for those contract rates to come down. But it's been interesting to see that just that July 4th upward movement in spot rates has really caused shippers to look at service, look at reliability across their carrier base instead of just continuing to chase the market down, because almost everybody at this point saying, we've seen the bottom, we're on our way back up. Even if it flattens out a little bit, I think everybody's looking at 2025 for really a next, major run up. Even though I would say there's some risk in the second half still for another, nice little run or turn up in the truckload market.
Yeah, there's always room for, a wrench to get thrown into it and make things all crazy again. But I do think it's interesting, like you said, we had that lead up to it, kind of fell flat, we kind of bring it back to July 4th a little bit. Instead of it being a big booming firework, it was just a little firecracker that basically went off. Now, would you attribute some of this because the way you're describing this, it makes me think that shippers are just getting a little bit more informed and smarter about what to do. They've gone through 4 years now of crazy up and down cycles where they understand that normal really isn't normal in freight anymore. You kind of have to be on your feet and be ready for anything. Is that the number one thing that you would point to here? Is them just being a little bit smarter about, okay, I need to actually look at this data and understand what's coming forward now instead of just trying to chase that bottom dollar. Let's now try to secure our supply chain moving forward. Is that what you would attribute that to, or am I just kind of like just barely touching the surface there?
Yeah, I think it's one thing to know that. It's another thing to do it. And what I mean by that is that, I think shippers understand volatility in the truckload market. They certainly, there were a lot of them that they got introduced, if they weren't already introduced, in the last few years. And so I'd say they're armed with better data than ever. I mean, you're talking about a lot of the major shippers have platforms like Sonar or other ways that they look at the market. And like I said, when I refer to everybody now saying that we're back on that upward trajectory as far as that next, peak in the truckload cycle, the furthest out projections are really into 2025. So between now and then is where it's kind of consensus estimates. And so when you look at the ocean container market and how rates on that side have surged, I think, again, we had talked about those teams largely sitting at some of the same tables and saying, look, here's your exposure. Be careful, because last time this happened, and this is really how you have to look at the data historically, is last time this index went surging, this all played out this way. And so, yeah, sure, I'm a lot more biased, I think, to how that can play out, maybe a little bit more on the leading edge when it does play out, right?
Right.
Because there's still potential for that to happen. It's one of those things where, this in terms of the truckload bidding cycle, I'd say, yeah, this is exactly what you're seeing here. You're seeing that shippers are now saying, okay, if we go any lower, there's risk. But it also, you had that July 4th that was kind of a wake-up call, like, hey, things can turn on a dime. And so if things turn on a dime again, would shippers be caught off guard in a lot of ways? Sure. But it's one of those things where, reacting with a monster of a portfolio of, lanes, it's very difficult for shippers when the market turns up so rapidly. So I think that helps really explain but they're armed with better data than ever. So just looking at van rejections, I mean, this is one of those things where we had been maintaining a nice spread over 2019, which is in that reddish orange, this year being in white. And now we're looking at almost neck and neck.
Yeah.
You can see very clearly kind of counter trend in terms of, how loose the market is relative to, past years, or I should say how tight relative to past years. But really, this is a deflationary metric here when you're looking at 4.28% of all van loads being rejected, and so when those contract rates go up, carriers are more accepting of those rates, right? And so you have the brokers who spot rates are going down. So it's one of those things where it's just a different dynamic, but really the shippers being willing to accept higher contract rates can soften what you're seeing as far as rejections, can soften the spot market. And so that's why it's such a good indication.
You can see it going down too.
Exactly. That's why it's a great leading indicator of, what spot rates are going to do. It's better. Okay. I mean, if you look at the consensus, all the reports coming out, FTR, DAT, I mean, everybody's saying it's notably better than last year, right? I mean, the bottom of the market in terms of spot rates was on a line haul basis was really looking at it in May of 2023. So again, we're kind of on that beginning stages of that next greater truckload cycle.
Right.
But we are seeing kind of in my mind, it's a very worrisome signal here, because it's like this is very counter trend on a seasonality basis. That if you look at like the spot rate forecast, it's wanting to turn up 10 cents in the next 2 weeks, because it's weighing so heavily this is like never happened with like, the past 5 years. This has been the most consistent, reliable seasonal trend. And then we're kind of moving, outside of that and going counter trend. So it's, we see signals like this. It's got to be a more pronounced and prolonged trend to be considered, notable.
Right.
But this is, it's a signal to watch, no doubt about it.
Absolutely.
Yeah. And it's certainly counter to what I thought could happen based on what was going on in July 4th with the import influx. Right. Again, the economy saying, wait a second,
no.
We may not be willing to turn up quite so fast. So, and it's a big part of it, right? Manufacturing, production. I mean, it's one of those things where even in the oil industry, gas and oil, whatever, going down in price. Mm-hmm. It's not very bullish for like, expanding your oil production, right? You don't want to increase the supply because you've already got downward pressure on rate from the demand side.
So how are carriers reacting to what's been going on?
So you basically have, I would say an escalation in number of exits. So this is just looking at the number of added versus the amount of carriers leaving the market. Mm-hmm. Still looking at an average of 337 from July of 2022, really when that great freight recession really began.
Right.
It kind of began a little bit earlier, but it was one of those things where you didn't really start to see carriers leave for a few months after that. But you had been seeing a noticeable. So if you look at like the LMI, Logistics Manager Index, a lot of these indices that are monthly would be talking about the carriers entering the market. It's starting to improve. Usually that's a good sign for the health of the truckload market. But now you've seen 2 prints, 2 consecutive weeks down. And again, it's got to be a more prolonged trend for it to really be, significant in terms of the direction of the overall market. Mm-hmm. But you've seen 2, much lower. So I think the last one was like 170, if I'm not mistaken. Then this is 227.
Right.
So that small shift in rates staying lower for longer will only make this more pronounced. And the amount of carriers just say, okay, it's time to hang it up. This market's never going to get better. And again, one of the strongest seasonal trends is, in the second half, especially with like peak holiday retail season. And if it fails again and the spot market doesn't get much better, it really takes the spot market turning up for carriers to, come in and kind of denote one of those periods where, hey, the market's it's going up, so let's get back in.
Mm-hmm. So. And it really feels like this is it. Like this is going to be the last couple quarters or so that some of these carriers that have been hanging on longer than maybe they even really need to. This is really their last opportunity, I would think, because if it does not turn up in the way that maybe they're hoping that it does, I think eventually this right here is going to catch up to them, where you've got this giant influx of carriers, and we just haven't quite seen that huge mass exodus yet. Wouldn't surprise me if, the market doesn't quite do what they want it to do by the end of the year. Mm-hmm. If in 2025 we start to see those numbers really stack up.
I would say so. It's one of those things where you have to look historically at what's happened. The X factor and, these data points, like why you can't trust, without a shadow of a doubt that this index going up is going to relate to this in this way. Because during the pandemic, there was so much money, there was so much propped up with loans. These small business administration loans for these carriers. I just think it continues to be what is keeping them around so long, with rates being, like you said, it's the thought there would be, even if there is some, they'll start to go delinquent, that the downturn would be more pronounced and therefore capacity would bleed out of the market at a faster rate, which we're seeing 2 weeks of that. If that continues, then certainly it creates greater volatility from the supply side, where that if demand, surges a significant amount, and again, the imports coming in look strong from a demand side, it could cause greater volatility, and that movement up could be, more rapid and more pronounced. This is really the data point that not only we've been talking about, but it's one of those where we're talking about disappointments to the downside. We're looking at U.S. containerized imports, and you're just going, wow, this is like a true peak season. We haven't seen this since pre-COVID, but also we've been talking about like the healthy restocking of inventories. But look at 2020. Yeah. We are like even just off where we were at 2020, which is that royal blue line that goes up. So we're a little bit below 2020 levels, but what you're going to see is those volumes are going to come into the ports, and you may actually see August register some record-breaking volumes for some of these ports, even beyond 2020. So this may all-time record-breaking month. So again, if you look at what the drayage carriers are saying over on the West Coast, there's been like a 60 to 70% increase in the amount of transloads, the amount of needed outside capacity. They're picking up new customers left and right. You've got the port strikes on the East Coast, Gulf Coast as a potential here at the end of September.
Right.
But it's really been interesting because we haven't seen this have a dramatic impact on the truckload market. The rails have just been absorbing this freight. I think that when you look at how inventories are going to play out, we'll talk about that here in a second, but the rails are just bound to get backlogged in a way where that freight becomes very urgent. So those transloads and those transshipping, it's not just because I went West Coast, I went West Coast, I wanted to go East Coast, now I've got to truck it across the coast. That is some of it. Mm-hmm. But some of this is because the rails have been rolling these containers. Mm-hmm. So when you look at Los Angeles and Long Beach, what's the projections for these ports alone? Los Angeles is in white, Long Beach is in red. I mean, you're looking at Long Beach just surging off the map. I mean, you're looking at potentially, record-breaking, months for not just August, but maybe even September for Long Beach.
They had one in July as well. They broke some
exactly.
They broke some records.
Exactly. Yeah, I should go back and say
Long
that.
Beach, yeah.
Right. Yeah, exactly. So when I talk about something, I kind of like leave it behind.
No,
yeah, you're right.
good.
Right. You
You're
had those
good,
records. The both of these combined is what's most notable. These ports are side by side. Mm-hmm. That's already happening for the volume that moved at the beginning of August.
Right.
So now look what we're staring down the pipe, pipe at here, beginning of September. So one of the most interesting things outside of this, because we're talking about the transshipment, we're talking about potential, volatility that may exist. Mm-hmm. In my mind, one of the only things to really, hang your hat on as far as things to watch out for. Yeah. I mean, you have the port strikes, you have this containerized import surge. You look around the markets and you go, what else is there out there that can do this? This is one of the things to just watch out for at this point. How much of an impact it'll have based on all the things that we're looking at from the, and how the economy just seems to be dragging things down to be softer. I think this is one of the things to watch. But the East Coast, so if there was a strike on the East Coast, what would you expect to see from, the Port of New York, New Jersey volumes?
Well, you would expect it all to get diverted somewhere else, mainly probably the West Coast if it's getting shipped from Asia.
Well, no, I think you're exactly right. I mean, so you're seeing
good because I guessed.
You're seeing this index surge for the Port of New York, New Jersey, at a period where if it doesn't make it here by the end of the month and they, the strikes occur. This is either there's transit times out there from Europe that they feel confident in making. Mm-hmm. That's a possibility. But there's also this thought process that may be, hey, the port strikes, we saw what happened with the Canadian rails.
Right. Government
may step in. There might be a quick end to this. You'd have to think that's not necessarily a bad way to look at it, right? I mean,
right.
The chance, if you look at just the overall chances, that may happen. But what's interesting here is if the strikes do happen, and then also everybody's just expecting that this volume has shifted West Coast. Mm-hmm. This is really showing this is a very even distribution of volume.
Oh yeah.
So when you look at what's happening on the West Coast, we would say that it's been more pronounced for longer. The surge there, that getting backed up can happen while these ports are booming too. Yeah. So you look at Savannah, you look at Charleston, they all have really solid numbers coming in here really within the next 3 to 4 weeks. Mm-hmm. So volumes are going to be coming in. How those distribute throughout the country, when if the capacity gets tight from the drayage side, you tend to see things roll over into the truckload market a lot more. I almost feel like that's, a sure thing to happen on the West Coast.
Right.
But it just really comes down to how what's the timeline on how this happens? Like, does it happen all in 1 week, 2 weeks, or is this a long drawn out thing? Mm-hmm. Kind of like interest rates seem to have been, but it's like it's really healthy on both sides.
Yeah, and I believe going back to record breaking months, I think New York and New Jersey both were, if they didn't have record breaking months, they're right on it. I'm pretty sure.
New York, New Jersey did that. They did say
they did. Okay.
Yeah. So we've been talking about that for 2 months. That just is how
loading up.
So that's one thing we know that we have. Like, we know we can predict that future. Mm-hmm. So this is one of those where we're saying, okay, this will arrive. So take that for what you will.
Yeah.
But if we know these things are true, that gives a better percentage chance to these other things potentially coming true. And so it really comes down to how well can the rails manage a lot of this volume. Not so much here, this distributes fairly locally, but it is one of those things, how well can the SoCal, because things happening in a big way over there can really, it can be disruptive to the entire market. We talk about capacity getting pulled into that market, trying to take advantage of it. Yeah. It pulls capacity when maybe the volumes arrive here at the port. And it just, there's only so many chassis. There's only so many drayage carriers. So your options become limited whenever volumes boom like this. And we basically are going to say that capacity will be running at close to maxed out very soon. And that will be a lot of the major ports, most notably the three largest ports.
Yeah, I mean, rail and intermodal and all those things have done an incredible job handling that capacity, as you've mentioned. Because really, if we take it back to a month or two ago, you and I really definitely would have thought, all right, no way they're going to be able to handle this. It's too much. Like we've seen in the past, they couldn't handle it. Well, that's the thing, is it happened in the past. And we've already talked about shippers and other people learning from their, quote unquote mistakes, or learning from just the way that things are now. That's another thing that to me kind of signals there are people that are getting better at this, and they're starting to understand, okay, well, how exactly can we distribute all of this freight in a way that does not overload one particular sector, or lead to this huge volatility that we would have expected the first time that it happened, or the second time that it happened. But now that we're in the third or fourth time that we've seen this roller coaster of freight in the last 4 or 5 years, I don't know, man. I think people are just getting better. I really think that's part of it, is that, maybe for depending on who you are, that's a good thing or a bad thing, that, people are getting better at this stuff. I'd say for carriers, it's not very good. But for the rest of everybody else out there, I kind of want to give them a little pat on the back just for being able to sort of prove us wrong and be like, no, we can handle this. We got it.
Yeah. Well, I think, again, you're always trying to look around the corner. You're always trying to see what's coming, because for us, as a brokerage, it's always going to be critical that we are, on that cutting edge, that razor's edge of those market turns. But you also need to be willing to admit that you were, surprised, and you use that to learn. You use that to learn, how, this equation that you had played out in your head may not equal the same outcome that you had, seen it play out in the past. Because it's dynamic. Oh yeah. The economy is in a certain position. You look across, the industry, certain, portions of the truckload market are, performing better relative to others. Now they're all starting to get dragged down. And so it's really one of these things where these are also, fairly new data points. They've only come up to the market in the last, few years, and people really start to understand them. I mean, this was one that was, arguably the most reliable, but also is one that doesn't tell you the full picture, but it does give you at least, 15, 30 days lead time. And there's no doubt they're getting better. All those things combined, and then the data, getting access to, you used to not be able to really benchmark ocean container rates, spot rates. And now, you have Zanetta, you have Freightos where you can do that reliably. So seeing the things like this volatility in the ocean container rates, right? These are signs and signals of like, okay, watch out. And now everybody begins watching, because if these two things surge historically, that's been a worrisome leading indicator. Because you also had data analysts, which shippers are more armed with those types of, personnel in their workforce. They have better analytical capabilities. All those things combined. So you're really looking at, no doubt. Are they exposed to a big, significant catalyst that happens in a short period of time? Certainly. Carriers will look to take advantage of that in the spot market. But navigating this, has become not easier, but has become arguably a better process, because they're able to get ahead of things a little faster. Yep. So this is one that, if you look back to the beginning of the year, you're starting to think about the Red Sea and the consequences that something like that had on ocean container rates. But then you get into really that surge of imports into the U.S. and you start to say, this is something everybody should be aware of. Our costs just went up dramatically. You're talking about to the tune of thousands and thousands of dollars per container. Now your cost of goods have gone up dramatically. So now you've got to highlight on the truckload sector. You're like, don't let this happen again. How can we? Well, if we accept higher contract rates, it may not happen. Exactly. We can maybe be able to. We'll at least get that service for longer, because if spot rates don't go above this threshold, we'll be good. And so, I think it's been really a big part of what we've seen here in the last couple of weeks, especially since July 4th.
Yeah.
But now this is starting to fade. I would be starting to say that this import boom is starting to fade.
It's not that time when that happens, though.
It is.
At early September, you're pretty much, if it's not here now, it's too late.
It is. But it's all, you're seeing rates start to slip. So carriers are, that volumes are like, capacity is basically you're having some other ocean container carriers come into the mix. They're word on the street. There's only 9 carriers, but there's been 2.
Word on the ocean.
There's only 9 carriers typically, that control 90%. But now there's, in this specific lane, there's been 2, 1 or 2, maybe even 3 or 4, enter the mix, starting to try to get attractive rates. That's pulling the market down. However, if the market was continuing to go up, and we've seen pretty clearly, we're not continuing to go up or stabilizing, and everybody's kind of wondering when's that going to fall off.
Right.
I do think that the pressure from the import side, like those volumes are still strong leaving today, but when you look a week, 2 weeks from now, I just don't think you can get 2 weeks from now and say those are going to continue to go up. There's really nothing driving it outside of this restocking for the holiday retail season, and just we'll talk about this, but upstream inventory. Being more elevated, it does show that there's some different tactics as far as inventory management. You talk about strategies, you talk about things that have improved. Inventories is certainly one of them.
Yeah.
Being left with an enormous inventory glut with this is really a scary position to be in for shippers. So getting back to that just-in-time management and front loading, trying to get that volume spread out and distributed across the country in a more even fashion. These are all strategies that have taken place and been capitalized upon in the last 5 years. Right. Especially in the last 2 to 3. So now you have a lot of the biggest shippers have a really diverse portfolio as far as lanes and outbound origins. And so it's one of those things that they've arguably been able to navigate this short July 4th, turn up, or just this next turn up of the truckload cycle quickly. Yeah. That contract rates turning up, it just shows that they are well aware that their exposure will only increase if they push rates down further.
Yeah, sounds like they've been watching Shifting Gears though. Huh?
They certainly have been taking notes. This is the real volume. This staying elevated during Labor Day is wild. Yeah, but we talked about the peak potentially in volumes leaving. I do think you're still at these extremely high levels. The timeline is shortening, man. We are now weeks away from peak holiday retail season. You're really the timeline, the urgency around these goods. You're not going to be able to afford to put them on the rails. That's why that 60 to 70% increase in the last 60 days of transshipment options, it's happening. Yeah. If this continues to stay elevated, then I think it would be a bigger shift faster as that timeline, as we get further along in that timeline. But I think, just like we're talking about being ready, shippers are a lot of times are armed with these data points about how long it takes, these dwell times between the vessel and getting on the rail, and they'll start to divert more of that volume. So if that happens over a shorter timeline, the higher the surge, in rates potentially. But if it happens in a more prolonged period, that it still will cause upward pressure, especially in the SoCal markets. Sure. But it'd be one of those where maybe it doesn't cause quite the uptick nationally that we would see. But I do think this is what I'm still saying that I think could be a big risk in the next month, 2 months. Would I have thought it would have gone that high? No, but at the same time, the rails arguably are as efficient as ever at moving this volume. Yeah. But I would say, okay, that may be true, but they still haven't got it good enough to manage this amount of volume. And so it's one of those things where we do know it's taking 2 to 3 weeks to get on the rail. So we know that. So it's one of those things where, from a shipper's perspective, it isn't going to go for long because they're going to say, we got to get another option. There's no way we can wait
it's got to get there quicker.
Yep. Because you're getting that traffic jam building up.
Yeah. So you think maybe in October, November, we might start seeing a little bit more of that theory start to take place if everything is going the way you think it is, which based on the evidence and everything else, it'd be really hard to disagree with you. I think the fact that it's not happened is not because it's I read the data wrong. It's because damn, they're getting good at this. Like, it's really just how it is. So I think really in the next month or two, you're going to start to see, okay, is my theory starting to hold water now?
Mm-hmm.
And I mean, based on the data points we're seeing, it'd be hard for me to argue against it.
Well,
however,
Well, I think so. So you have rail volumes moving outbound LA, Los Angeles. So what this is objectively looking at is just that. What do you also have? You have higher volumes coming in that now we're talking about transshipments being up. That may be facilitating a lot of that volume.
Sure.
This volume may still have had time to move. So really, I'm looking at the next 2 weeks. We're going to want to see this Labor Day, period kind of shake out. But like I said, if you look at all rail volumes out of Los Angeles, it's come down significantly because of the holiday.
Sure.
It's this remaining high tells me that when we're going to come back out of this, moving 7-day average, blazing.
Yeah.
And I think that every day I'm going to be looking at it because when I do think it happens, I think it'll be dramatic.
Yes.
And that would be the point where you're starting to say, okay, truckload rates, we've really got to keep an eye on these short regional hauls. Like we saw it play out before July 4th. This exact same thing happened. So we saw Los Angeles to Salt Lake, Denver, some of these shorter moves became less desirable.
Sure.
Spot rates ended up going up because capacity was looking for these longer haul moves. Those will be the kind of the dominoes that we're watching to see if this really shakes out the way I think it can. And then just to touch on this real quick, the logistics manager index, I mean, We're talking about the bottom. We're talking about trending up. I mean, logistics manager index is a survey done by Colorado State and Zach Rogers, that crowd. Really in-depth report. I recommend, reading it every month. Mm-hmm. But it's basically saying that we're in a period of, we're out of a period of contraction. We're in a period of expansion. But it looks just a little bit. Well, you're even seeing some sideways movement. And again, so you could see, and then you could see it start to go, a little sideline move there. But there's different portions of this. So we talk about inventory levels. We had pointed to this as why we thought the import boom was surging, restocking the inventories. That's almost consensus now. But we're looking at this as positive. But it's broken out between upstream, manufacturers, wholesalers, and downstream. Downstream is more retail oriented. Downstream is, in contraction. Mm-hmm. Upstream is in expansion, so much so that it's, and I guess you could say they're barely in contraction, but at the same time, they're not in expansion. So that holiday retail season, again, we talk about that timeline. Mm-hmm. We're talking about a month to 2 months for all of this to take place without disrupting the freight market. I just think, yes, I would agree now with everyone that the economy's finally, we've been bearish for so long. We're like, is the economy ever going to head fake us? Is it ever going to get
Bloomberg
that?
is shaking their head.
Well, everybody
like, oh, come on.
I mean, no kidding. The truckload market in 2022 was like, we're in trouble. Yeah. And then consumers just kept spending. I mean, it was really one of those things where did all this money come from? And slowly over time, we figured out that there's just more money than anybody really thought. And it went to more of the right people than anybody thought. And so we see the truckload market start to turn up, and it's like the economy's like, this election cycle, we really want to keep it lower for longer. It appears, but again, we've talked about reasons why. I use this to basically say this pure reading of 55, this expansion, inventories are rebuilding. I think with the amount of imports that we're seeing in the just-in-time management inventory styles, talking about better than ever. Mm-hmm. I mean, you're talking about going from an inventory glut to lean, and now you know the difference between the two. Those retailers are going to want to sell through these goods. They're not going to want to be caught on the backside of this. So things economically are looking bad. You're thinking about, oh no, I'm going to go into 2025 with too much inventory now. Your incentive from a shipper standpoint to sell through this downstream, guys, the upstream guys may be looking to capitalize whenever the market gets hot again, right? Sure. Maybe like, okay, these are things that we can hold for years. I mean, there's products coming in right now that have very short timelines, and this is the season that this product, this brand, this whatever, we got to sell through it. So that's why I think you're now talking about 2 months, maybe a month and a half, where this freight's got to get here. get moving. I mean,
Yeah.
that timeline that I've been referring to, that's the timeline.
Mm-hmm.
So we'll see how it shakes out. I mean, you could say that I've been wrong about getting bullish about the truckload cycle, and you wouldn't necessarily be wrong. You definitely wouldn't necessarily be inaccurate, I guess you could say.
Mm-hmm.
What I've learned to do is taper my expectations around the economy. It could still throw, curveballs. And I think most people would say we've seen this coming for a long time. So it's just one of those things where I will just continue to say, okay, these are exceptions. I'll add that to the arsenal. We'll learn. We'll get better. Mm-hmm. But I just still would say that there is risk out there. So to completely de-risk the rest of the second half, I think would be a bad move. But to also be overly optimistic would be an equally as bad move. Mm-hmm. So it's one of those things where we'll sit and watch. And I think that only looking at the real-time data is the only way to do that, because if it shifts one way or the other, you got to be able to shift your strategy and capitalize on it.
I guess to sort of wrap a bow on that, then, you mentioned you're going to be keeping a close eye on some of these data points to sort of see how the rest of the year shakes out. What are some data points, or what are some things, maybe not super granular here, but like what are some of the general things that if you're talking to me as a shipper and you were giving me advice on how to handle the rest of this year, maybe I've done a pretty good job so far of like keeping things okay. I just negotiated new contract rates. They're higher because I know they need to be. So let's get it, right around there. I think I've got all my inventory here. But I'm with you, Henry. I think something might be off. What can I do to just sort of keep an eye on things?
So we've talked about the pot on the kettle for quite some time.
Yeah.
Has the fire died down slowly or slightly? Sure. Mm-hmm. There's a thin line we're walking right now between the market turning up rapidly or getting scarily soft.
Yeah.
What I would say to shippers is, number one, you must watch the East Coast, Gulf Coast port strikes. Chances are that's going to go well. Mm-hmm. From data point perspective, keep watching port volumes. But we already know we're going to see records break. So maybe not even that. Maybe it's just dwell times. You really want to be looking at the Port of Los Angeles, what they're saying about container turn times, dwell times. And you talked about empty containers in the beginning. Those empty containers have also started to come down. Mm-hmm. So we're potentially easing as far as pressure from the ocean side and imports from overseas. But really, the freight's already on the way. Right. So those rail dwell times, how long those containers are waiting from the vessel to get on the rails, container turn times, because you really want to be looking at how full is the port. Okay, the port broke a record, but what does that mean as far as how those downstream assets are handling that volume? And if we continue to break records, you've now got even more volume. So your exposure to that capacity maxing out from drayage and chassis is very high. So this is going to transition into this. So transshipments, you can ask your, drayage providers. You can ask us, try to keep an eye on exactly Southern California, Port of New York, New Jersey, in the next month, how, what's playing out from a capacity perspective and those dwell times.
Yeah, exactly. Because as those dwell times, if they continue to sort of tick up, like you mentioned earlier, it's go time. Yep. These shipments need to get to where they need to go quickly. Mm-hmm. And if it's going to take too long of a time, well, I'm not putting it on a rail. Right. So now all of a sudden, here we go, spot market. Let's get it. Right. So yes, as you mentioned, I think that is absolutely the thing to look forward to. Is just how exactly congested are these ports? How long do I have to wait for my product to get to places? And if I do need to wait a long time, I need to know about that ahead of time so that I can get my options, all in a row.
Yeah, I would be thinking about. You got container freight on the water. Mm-hmm. It's 14 days out. Rail dwell times are ticking up from 7 to 14. So you're looking at a week to 2 weeks. So now we're talking about 4 weeks. We're talking about a month to 2 months before you have to have that inventory here and on the shelves potentially. Mm-hmm. So it leaves you like a month to do all that. Yeah. So you really start thinking about the stuff that's on the water. It start to have contingency plans in place, because that stuff is the most highly exposed. The stuff that's already sailed, can't be diverted. It's going there no matter what happens in SoCal. And that is a large percentage of freight, like we saw earlier.
Yeah, exactly. And if any of you guys out there have some freight on the water and you're starting to kind of worry a little bit and be like, oh, I might need to get this where it needs to go a little bit quicker. Well, guess what? That's what we're here for. We have all the freight solutions and all the smart people like Henry Byers over here to make sure your supply chain is up and running and good to go for the rest of the peak season. If you want to get any more information about us, we've got all of our social media channels on our website and all that good stuff down in the description. Go check out some of our other episodes if you want to find out how we got here. If you want to just sort of, keep track of the data as it goes and keep updated with the story, because it's like a soap opera. Every week it's completely different. Thank you guys for watching. We appreciate y'all spending your time with us. We hope y'all have a great rest of the week, and we'll see you later. Bye.
Thanks.